Good evening, everyone, and welcome to the John Galt, FLA.com weekly DeathBurger financial report. This is John Galt speaking. As you know, I've been taking a hiatus to take care of some other business and personal affairs, but we're back. We're back strong. We're back solid, and the news justifies a callback. If you wish to listen to the program, tune to the Watchman.fm Monday through Friday from 7 to 9 p.m. Eastern Time to listen to my broadcast and commentary and the financial report as brought to you by a bunch of dancing bananas. The news this week is really quite simple to focus on. We had riots in Tunisia. The riots in Tunisia have spread over to riots in Egypt. The riots in Egypt actually generated a lot of sympathy in the Arab world. We had protests in Jordan, Yemen, Oman, Morocco, Algeria, and of course the potential of a Sudanese civil war, and even, that's right, the picture you see now, a protest in Jeddah. Now that fire is a result of flooding that occurred there, and they are very upset with their government. The flooding was widespread, and the government was very slow to respond, which is typical of the Saudi authorities. The result of the riots in Egypt created a cratering effect for their stock markets on Saturday, a 6.429% decline, as you can see from Bloomberg.com. And it didn't exactly abate itself until the banksters from Saudi Arabia and the Sheikh came in and decided to buy the market on Sunday, try and boost things up a little bit, but a 2.4% does not offset a 6%, and it was a nasty, nasty decline. They're concerned there. The rest of the Middle Eastern markets were also down severely. The Bahrain market, not so bad, 1.43%. It got hit, but not crippling effect. The Dubai and United Arab Emirates markets, they got killed. The FTSE NASDAQ Dubai UAE 20 down 6.1. The DFM General down 4.3. It spread across the rest of the markets as people began to realize the despot crash was on. As you can tell from this, it's on and on. Every market you look at just crashed. Here's the Qatari index down 2.9. You saw it in Bahrain. You saw it in Oman. It is a non-stop situation. And this problem, Jordan, same thing. This problem had no reassurance from the United States. In fact, our clown-in-chief has no idea how to deal with this situation, and Israel is deeply concerned because we're very late to the party again, and the Tel Aviv index crashed 3.3% as a result. The question is, what nation is next going to collapse from this wave of popular sentiment? Could it be Jordan? Jordan is a very unstable, poor regime, a dictatorship by all essential purposes. If you call a monarchy a democracy, you're crazy. Could it be Morocco, another friend of the United States, also under the thumb of a monarchy for decades, and also very, very repressive? Could it be Algeria, the headache of the French, coming back to become a headache of the West overall? We don't know. Another nation ignored but very critical from the point of strategic positioning, Oman. Right next to Yemen, right next to Saudi Arabia and the UAE. A crucial ally, Saudi Arabia. It's a powder keg waiting to go off. The royals will do all they can to buy off the citizens. No one knows what will happen. Lastly, Yemen. A very disturbing point in the map. It could fall easily. It's very weak and unable. But other areas you have to worry about too. Could be St. Louis be next? Could St. Louis have rioting due to food prices and inflation? This is what we have to worry about in the summer. Our own cities. New York City. Everyone says things are wonderful there. The problem is it's wonderful if you're in Manhattan. When you get out into the boroughs where the poor and middle class live, there is no real evidence of a massive recovery. Los Angeles, it's Beirut waiting to happen. Los Angeles is split into 3 different cities. Unfortunately, the media only covers Hollywood. Atlanta, also a powder keg waiting to happen. Who knows what would happen if we see food prices accelerate along with an energy price spike? And lastly, Chicago. That's right. The Barry Soetoro-in-Chief's hometown could easily go up in flames this summer, especially if unemployment continues to worsen. The Dow in January basically has wiped out all of its gains for the year. We're starting back on January 1st, on January 31st. Tomorrow's action will be most interesting. We could easily see a rally tomorrow, or we could easily see another 2 to 3% decline. No one knows. Everything is now dependent not on strategy, technicals, fundamentals, but on overseas events. For the year, it looks great. A one-year chart shows Hey, it's not the worst shape ever. We could sit there and continue to march forward, but that one drop was so massive on the way to 13,000. It really could be called a key reversal. A lot of stocks were damaged technically. We could see this continue and extend. But let's look at a broader index, the S&P 500. Again, back to where it started the year at. Started off, now we're back. That's not a good sign. You haven't gone anywhere in 30 days. You also had low volume for most of the trading days. The biggest volume was on the down days most of the time. You had two major down days and some other ones. Again, the one-year chart shows a little bit of uncertainty as we reach this area. Are we seeing a major top? It could quite possibly be a major by being intermediate or short-term top, not a long-term. We don't know yet. It's too early to tell. If they break down further in the small caps like the NASDAQ, it could well be a long-term top. If you look at the NASDAQ composite, we started off nice in the beginning of the month, and now we've given it all back and then some. And even as you extend it through the individual stocks in the index, it is not a pretty picture. The one-year chart reflects the same thing. That massive down candlestick is a very bad sign. I think we're going to break the 50-day moving average in the weeks to come, and that will be, as they say, adios, at least for the short term. And we could see that first quarter correction that I've been predicting. Russell 2000 is in even worse shape. It's almost back to the 50-day moving average. You can see it in the lower right-hand corner of that chart. It's got about 3 points to go. We could easily take that out on Monday. We'll see what happens. The one-year chart reflects the same thing, and you can tell it's getting very, very close to where you have to be cautious about what's next in our markets. The small caps told the story. The Dow Transport Average really indicated there's a problem slicing through the 50-day moving average. If it continues on this downward trend and breaks the 4860, 4850 level, it's game on. Right now it's just below 5,000. I think we will see a massive cratering there. The big pain was felt obviously in the overseas ETFs, some of the ones that were recommended by Bubble Vision, like the Egypt Market Vectors Egypt Index. As you can see, it's broken below the 50 and 200-day moving average, and the 200 days relatively new because it's a fresh ETF, and has cratered and now will no longer be trading because they're not trading in Egypt. Curious to see what happens there. The Africa ETF, Market Vectors Africa, sliced through the 50-day moving average, is just barely, maybe a point and a half above the 200-day moving average. I don't expect it to hold, especially once the civil war in Sudan starts. Of course, reaction from Bubble Vision, yeah, you heard them, the crickets. What does that tell you about them? Same thing I feel. Meanwhile, the Baltic Dry Index continues to reflect a decline, or the potential for a massive decline, in world commerce. I have the feeling we're going to start seeing the stories about the overcapacity of the ship industry and what's going on in the Far East. This story is being ignored. I got to give ZeroHedge.com credit. He's been covering it since day one and really hammering the point. This thing is broken down completely, well below 1,200. In the overseas currency exchanges, the euro, it looks like the short-term rally has fizzled. It looks like it's getting ready to reverse, and I would not be shocked to see this drop back below the 130 level really, really fast with the instability in the Middle East. Meanwhile, the safe currencies like the Aussie are holding above the 50-day moving average and appear to be building a new consolidation pattern. That should be of great concern to the U.S. dollar because it really does reflect reality. The Canadian currency, the loonie, in the same position. Despite the down tick on Friday, it still appears to be a flight to safety currency like the U.S. dollar. What's happening now, though, is overseas markets are getting a closer look. The Chinese market is breaking down completely. The 50-day moving average is rolled over. It has kissed the 200-day moving average. And I have the funny feeling, as you see it in the FXI in the chart, we're going to see a total disintegration of the Chinese financial markets. Meanwhile, on the Municide front, some people seem to think that our economy is going to go on unchecked, unscathed, absolutely without a worry in the world about the municipal bond market. And the one really good-looking analyst on this subject, Meredith Whitney, has been beaten like an ugly dog. She is not an ugly dog. She knows what she's talking about, even though she gave a cursory overview. The primary stuff's only available to her subscribers. I've been subscribing to the Municide Theory for ages. If you look at an update on some of the charts we looked at last month, The Naveen Municipal Closed-End ETF Price Return Index has not recovered after the death cross that we saw in December, and in fact is trading below the 50-day moving average and substantially below the 200-day moving average. No sign of an improvement. It appears to have lost momentum and will fail here below the 50-day moving average. The Nuveen Barclays Capital New York Municipal Bond Fund is telling you that no one has faith in the state of New York to straighten out its budget mess, and it looks like it's getting ready to roll over too, short of the 50-day moving average. Let's go over to the Florida one. Same deal. We're approaching the 50-day moving average, but our governor, despite his good intentions, does not appear to have a plan to really deal with the $3.5 billion shortfall. Not good. Meanwhile, PIMCO is still dealing with California. It's crawled above the 50-day moving average, but if you look at it, it's hit a short-term resistance level. It appears to be getting ready to roll over, and I think we're going back down below the 50-day moving average, and we will see further deterioration in the California Municipal Income Fund. The next PIMCO fund is another muni fund for California from PIMCO. Another one we looked at, barely made the 50-day moving average. Everything technically indicates it's going to fail, roll over here, and go down hard. This should be upsetting to people because this is part of the pension problem that has not been discussed. Lastly, the Columbia High Yield Municipal Bond Fund, it had a death cross right off the bat this year, has attempted a very weak bounce and still hasn't made it back to the 930 level. It's a very thinly traded fund, so not a lot can be made of it, but it's just to indicate the general condition of the market as a whole. Meanwhile, the shiny metals have been making the news. Gold has been in a technical correction which is long overdue, and I do mean long overdue, well below the 50-day moving average, still holding above the 200, but I think we're going to see it cross at some point. Why should people not panic? Well, number one, once we see the dollar rally substantially, Ben the Bernanke, as a lot of people are starting to call him, has no choice but to sit there and double down on his quantitative easing. He is not going to be able to do it. He doesn't know what's going on in the Middle East. He doesn't understand the problems that we're facing, and it's going to sit there and bite him in the butt if he doesn't double down on it. So he's going to just take the easy way out and print more money. So this short-term correction in gold is not going to sit there and enhance the physical supply any, but it will give you a chance to get in at lower prices with dealers who are not aware of what they're doing or who are putting all of their inventory in the market. Silver is in the same bet. If you notice, we had a nice rally on Friday with the African crisis and Middle Eastern crisis. We've been in a short-term correction. It should have corrected further. Realistically, we should have been trading between $25 and $26 an ounce. It did not because of what happened in the Middle East, the proverbial African black swan, as it's being called by some. We could see it rally back to the 50-day, but I still think at some point in time it rolls over and starts moving downward. Why? Well, this particular index in this chart I'm showing you is the Trade-Weighted Exchange Index. This is provided by the Federal Reserve. Major currencies. We've seen no substantial rally in this particular index this year or last year. We had the one bump up. We should see a spike up this year. I think if the pattern holds true, it will fall short of the 80 level, roll over, and really start to crash in the second half of this year as stability returns to the markets. This is going to impact the regional banking index, where the reality of the real estate crisis comes back home to roost as they have to start foreclosing on more homes and start eating the great giant proverbial poop sandwich they created for themselves. As you can see, we're just above the 50-day moving average by a couple of points. I think we slice through that and crater, and I do mean crater, to some new lows on the KBW Philadelphia Regional Banking Index. The one-year chart shows a really nice pattern, and if you see the death cross that we had in August and then the golden cross we've had at the start of this year, I think the golden cross fails and we retest the 42 level on the KBW Regional Banking Index probably by early spring, with a continued rollover into the summer before the next Ben Bernanke guarantee to buy everything out in the known universe event occurs. Lastly, Bank of America. My favorite proxy for what's wrong with the real estate market did not make it above the 200-day moving average, is still mired in a death cross that it experienced last July. One of the largest banks in the United States has not recovered despite the best efforts. It got above the 50, which is supposed to be positive, but it's not going to last. Listen, if you want to hear more, tune in to John Galt on thewatchman.fm Monday through Friday from 7 to 9 p.m. only at www.thewatchman.fm. And stay tuned at my homepage at johngaltfla.com for more.